Afternoon, welcome to Business Lunch. I'm Sonia Shenoy. With me is Pavitra Parekh. Well, Pavitra, so very quiet, right? The market, as we head closer and closer to the end of the year, it seems like the volumes are thinning down. The market participation is lower. No surprises here, right? Everyone's out. The only good part is that after the pullback yesterday, we've kind of held on to that 18,000 level, which is not such a bad thing.
Oh, absolutely. Like you said, not too much going on, you know. So I guess this is what you expect at the end of the year as well, right? And for the rest of the Asian markets, again, you're seeing extremely quiet trade. There isn't too much going on. It is the Nifty Bank, which is a little bit under pressure today. But the headline index is absolutely quiet. In terms of cues to monitor now, it's probably, there's not much once again, but it's the China reopening and what it could really mean for crude prices and what's going on with the metals pack. So that's something that we're tracking. And we'll talk about that in a little more detail later. But first up, let's talk about some individual names as well. HEG is surging in trade today. This after the company unveiled its plans to enter the lithium-ion segment with capex of around 2,000 crore rupees. Vivek is standing by with more details. Vivek?
Movers in today's trading session along with the entire metal pack. The graphite electrode makers too are surging. When you're talking about HEG specifically, what the company has intimated to the exchanges is the fact that they've gone ahead and incorporated a wholly owned subsidiary by the name of TSCC, which is going to manufacture graphite anodes for lithium-ion cells. So what analysts tell us is that, the opportunity size for this particular market is quite big, and which is why, the analysts at this point of time believe that the HEG can benefit quite significantly and materially from this particular inflow. So 2,000 crore capex, as you mentioned, is what they've announced. It's going to be done in two phases. The first phase of 1,000 crores of capex is going to cater to 10 to 12 gigawatt hour of cell manufacturing capacity, and phase 2 is going to be a further 1,000 crore capex to double the capacity to cater to almost 20 to 22 gigawatt hour of cell manufacturing capacity. Along with that, there has been a sharp rebound from September lows as far as the electrode prices are concerned, so which is why you're seeing some positive sentiment of both of these stocks.
Okay, thanks a lot for that. So those are a couple of stocks that are doing well, but Laurus Labs is under quite a bit of pressure today after a fire broke out at its unit in Visakhapatnam. Ekta is here to give us more details on that. Ekta, over to you.
Thanks for that. Well, yes, negative news for Laurus Labs because a fire has occurred in a block of their manufacturing Unit 3 plant in Visakhapatnam. Operations in the other facilities or blocks are running normally as per the company. Now, 2 employees as well as 2 contract employees have unfortunately lost their lives on reaching hospital, and 1 regular employee is undergoing treatment. So that's as per the statement which has been put out by the company. The company has also launched an investigation into the incident, and the company as of now estimates no material impact in terms of operations, but nonetheless unfortunate news which is coming in for Laurus Labs.
Oh, absolutely. That is tragic news on Laurus Labs. The stock is also under pressure, around 3% in the red. But moving on now, Mahindra CIE is buzzing after brokerage house Motilal Oswal has issued a buy call on the stock. Sonia, tell us more about this.
So, the management of Mahindra CIE met with the analysts at Motilal Oswal, and the takeaways were quite positive. On one hand, there is this German commercial vehicle unit that they are looking to sell. And Motilal Oswal says that the proposed sale of this German CV forgings business is a positive because what it does is it cleans up the balance sheet and it will result in a better financial performance. But apart from that, even the India business is seeing very strong traction, especially because Mahindra CIE is supplying to a lot of the EV makers, and hence there's more business coming through from there. The management has reiterated its focus on profitable growth and has also spoken about achieving margins of 15% in the near term compared to 12% that they closed in 2021. So there is big upside expected both in terms of earnings as well as the fact that they're looking to sell off their commercial vehicle forgings business is looked at positively by the street. But moving on from autos to sugar stocks are buzzing as raw sugar prices have risen. Some policy-related news flow is also expected. Manisha is here with the details. Manisha, over to you.
Well, yes, the sweet run continues in case of coffee, where the global raw sugar price is still holding around those 6-year highs. We also have seen prices gain up by nearly 10% in this year until now. And there are concerns about global availability. And then you also have super strong speculative buying in the international markets, also supporting sugar. For the Indian markets, it's all about the ministries and the measures that we are awaiting. To begin with, the Ministry of Consumer Affairs on 26 December has said that there's going to be a 100% incentive on sugar sugar for ethanol and B-heavy molasses from cane juice there. So there is a big incentive now coming in for the market here, and this formula will come into effect from January 2023. The other is from the Petroleum Ministry, where the markets are expecting a revision of the ethanol prices. This is ethanol that will be made from the damaged food grains, and the current prices, while they stand at 55.54 per litre, the industry is expecting somewhere around between 3 to 4.5 rupees of a revision on the upside on this one. So in expectation of that as well, we have seen support continuing for the sector.
All right, Manisha, thanks a lot for that. And it is on the back of this that all of these sugar stocks are really moving around. But with that, let's also bring you some important corporate commentary, which indicates that inflationary pressures are eating into discretionary consumption. So the management of VMart told us earlier this morning that demand has dipped sharply in December, while TCS Express emphasized on falling volumes of e-commerce purchases as inflation begins to hit wallets. So let's listen into what both of the managements of these companies had to tell us.
Seeing a little lull, and then people are once again, the winter was not there for the last 15 days, and then now once again in this week we are seeing winter coming back. So it is once again coming back. So largely it is driven by seasonality or festival or the need in the family, which is wedding. So need-based shopping is happening, but other than that, the aspirational levels are not getting met because there is a stress in the customer's pocket. So we are seeing a little dull from that perspective if we compare it from the pre-COVID levels. Same-store sales growth looks a little difficult in this particular year, but in the next year, definitely same-store sales growth, I am just comparing it from the 2019 pre-COVID level. But if I look at from the 21-22 levels, it will definitely be positive. It will be, I can't tell you the number right now, but yeah, we will see some good number coming in.
In India, we don't really have, the demand hasn't taken off the way it should have. And the cost is still quite high in terms of delivery. And that has not come down. So we do not have the option of getting economies of scale in e-commerce. And of course, investments are very high. So what it overall means is that the profitability is going to be very less or negative for that matter. And I'm not saying that it's the question of it now. Ever since it has happened, ever since e-commerce has started in India, from 2012, it's the same story. It's been 10 years. No company has ever made any profit in this.
All right, well, let's move on. As part of our special series, Wizards of the Street, BSE member Ramesh Damani caught up with Prashant Khemka, the founder of White Oak Capital Management, and asked him about how India could become a major player in the global supply chain. They also discussed the prospects of the Indian IT sector. Listen in to what he had to say.
Globalization is very much there for good, and it is maybe a bit of a speed breaker in the interim, but for India it's actually can be a very positive game changer of sorts, because the companies worldwide are very keen to diversify their supply chains.
From China,
from
so it's the India plus one.
Absolutely. From excessive dependence on China, they want to diversify. India has the opportunity, and it should grab it with both hands, which it is doing so, but I think there's always room to do a lot more. It's an opportunity.
So Apple does 5,000 crores of iPhone sales. That telling sign to you?
That is certainly, from India's perspective, a very big positive. The opportunity size in front of us is, compared to that, is like tens of times, if not hundreds of times bigger, if you look at the manufacturing sector as a whole. IT services, if I take as an example, from time to time, they get written off by the market. One of the things that market has for the last decade or so believed is that IT services sector is an X-growth sector in India. Because they think of, or X-growth sector, because NESCOM and IT companies, they guide in dollar terms or constant currency terms, which are like dollar equivalent. So they talk about 7 to 8% growth. Now, in India, 7 to 8% growth doesn't appeal to anyone.
Doesn't wake up anyone.
Yeah, if you are less than double digit, you are no growth or slow growth company.
All right, that is Prashant Khemka talking about the potential of the Indian markets and specifically on what IT can do. But with that, we have to get into our first short break on the show. On the other side, mock drills are being conducted in hospitals across the country to check for COVID preparedness. We'll get you more. Welcome back, and let's now bring you the latest on the COVID situation in China. The country continues to open up and relax its previously stringent anti-COVID norms. So starting early next year, that's early in Jan, Beijing is set to drop quarantine for travelers arriving from abroad. CNBC's Taimur Nabili filed this report. Take a look.
Beijing has taken another major step, in fact, the final step, really, to dismantle its harsh COVID restrictions. The country's National Health Commission has announced it'll scrap the quarantine requirements for inbound travellers from January the 8th of next year, which is literally less than 2 weeks away. This will end the current regime, which involves 5 days of mandatory hotel quarantine and 3 days of self-isolation at home. But travellers to China will still be required to obtain negative COVID test results within 48 hours of their departure. China will also downgrade COVID-19 from a Class A infectious disease rating to Class B, meaning that local authorities can no longer shut down entire communities with COVID as a reason. That'll start next month as well.
Okay, China is dropping quarantine for inbound travellers. But moving on to the situation in India then, mock drills are being conducted in hospitals across India to check for COVID preparedness amidst a rise in COVID cases in several countries. Though the Health Ministry has clarified that there's no reason for immediate alarm, precautionary measures are being taken by the central and state governments. Abhimanyu reports from Delhi's Safdarjung Hospital. Take a look.
Mock drills are being conducted across India to check for COVID preparedness at COVID care centers. Some of them are makeshift centers which have been prepared at various hospitals. We are currently standing at the Safdarjung Hospital in Delhi, where the Union Health Minister Mansukh Mandavia had paid a visit in the morning. Several state health ministers had also visited similar facilities in their respective states. Though the number of COVID cases is low as of now and there is no immediate reason for alarm, still the union government as well as states are taking rearguard action to ensure that there are ample number of COVID facilities, drugs, and the entire setup is in place if at all the number of COVID cases increases. The makeshift facility we are standing at right now has various areas. This is the triage area where any new patient is brought in, and based on the severity of symptoms and disease, the patient is either sent to the COVID ward if at all the patient is asymptomatic. However, if the patient is displaying acute symptoms, the patient is sent to the Sari ward, which is located just adjacent to the triage area, which is the severe acute respiratory infection ward, where even patients who are yet to get tested positive for COVID and may suffer from some other respiratory infection are also sent to this ward. Contains an ICU, ventilators and various other intensive care mechanisms to ensure immediate relief for various patients. As of now, such wards have been created as part of makeshift arrangements across the country, and there are also pre-existing arrangements which are continuing across India's hospitals.
Abhimanyu, thanks a lot for bringing us all of the details on these mock drills being carried out across hospitals. In fact, Health Minister Mansukh Mandavia also held a meeting with prominent doctors as well as members of the Indian Medical Association yesterday regarding the COVID situation in the country. So the Health Minister in the meeting emphasized the need to ignore fake news regarding the disease and avoid unnecessary panic. He also stressed on the need to observe masking as well as hand hygiene. The Health Ministers also asked doctors to participate in TV debates. This is in order to dispel any rumors about the disease. And he also clarified that the BF7 variant was already present in India, but there was no need really to be worried, as the no-zero COVID policy along with high vaccination has built a natural immunity in the population. So that is everything that is being done in order to, prepare for the worst, if at all.
Okay, well, let's take a short break on that note for now. When we come back, we'll get back to the equity markets. We'll get you more news and updates on the other side of this short break. Stay tuned. Welcome back to Business Lunch on CNBC-TV18. Well, for now, the market is picking up a bit of pace, actually. So the Nifty and the Sensex are up about 0.2%, and the Bank Nifty is just a tad bit under pressure. But let's move on. Euphoria, scandal, meltdown, contagion, bankruptcy, manhunts, arrests. If it's the drama you were looking for, the cryptocurrency ecosystem has had it all. 2022 became the year that broke crypto's back. Manisha Gupta recounts what could have been, what went wrong, and what 2023 holds for the asset class that could have been.
The year 2022 witnessed the crypto winter loaded with sell-offs, scandals, layoffs, and unfavorable macros and markets. The shutdowns, rug pulls, and the contagions that followed made matters further difficult. The market is full of debt due to rise of centralized lending schemes. 2020 onwards saw a huge build-out in retail, yield-based DeFi, crypto shadow banking, and unsecured or under-collateralized lending. The pain started with a sustained sell-off in cryptos. For the current year, the prices have declined sharply, down by 60% for Bitcoin, Ethereum is down 64%, decentralized Mana is negative 88%, and meme coins Doge and Shiba Inu down 47 to 72%. The total crypto market capital hit peak at their $3 trillion, which has now come crashing down to below $1 trillion, a more than 70% of decline. The sell-off was accentuated by collapse of algorithmic stablecoin Terra USD. It was clear from the events that followed that the credit risks and counterparty risks were not assessed with vigilance. Down went the Celsius network, once valued at $20 billion. Same happened with Three Arrow Capital. Equinox, which was listed on Nasdaq, also shut shop. The other names like Wald, Voyager Digital met with the same fate. And towards the end of the year, the once valued at $32 billion FTX crypto exchange filed for bankruptcy, followed by BlockFi and Bitfront in Singapore. The other market, which is NFTs, and that was quite a rage and became a mainstream phenomena in 2021, also saw a meltdown in 2022, with volumes crashing nearly 70%. And then there is more, and this is from miners who, due to fall in crypto prices, have not paid electricity bills, leading them to sell their holdings. The total cryptocurrencies as of now stand at more than 10,000 in number, and in last 10 years, nearly 2,421 cryptos have failed. When markets started to fall, funds, lenders, others were forced to sell, leading to a domino effect. Street believes that 2022 may be drawing to an end, but the crypto winter could last another 6 to 8 months.
Manisha, thanks a lot for wrapping up all of that action from the world of cryptos. It has truly been a hectic year for that entire world of cryptocurrencies. But with that, we are going to move on. And as we wrap down on this edition of Business Lunch, here is some opinion coming in from Gautam Shah of Goldilocks Research. This is on what he makes of the market from a technical standpoint. Take a look. Thanks for tuning in. And you have Midcap Radar after this short break.
We've gone a little cautious and conservative at this point of time. We just want to take a step back and understand this setup better before we can actually take a call for the next 1 to 3 months. And I think, like most people, 18,100 clearly is an important resistance that we are working with. We need a close past the same to give that first confirmation that last week was just a one-off kind of a decline. And the ceiling on the upside is about 18,250. So I think broadly we are in that band of 17,800 to 18,250. I want to believe that what happened in the last couple of weeks was just one-off. It was pretty much forced selling, which will get absorbed quickly. But for that, I need concrete triggers on the charts. And if at any point of time 17,800 were to break on a closing basis, that would pretty much be game, set, and match to the bears. And then, maybe we get into a medium-term downtrend. I want to be sector specific, I want to be stock specific, and I'm focusing more on the top 100 large caps at this point of time and just letting go of the mid cap, small caps just for the time being. Given what we've seen in the last 2.5 weeks, and January and February, we just have too much on our platter, whether it's earnings, the budget, and the global market developments, and the impact of possible, COVID that could come in over the next 2 to 2.5 weeks. So large caps is where safety is. At least you have the liquidity, you can get in, get out really, really fast. And I think the top 100 has really not been impacted so much in the last 1 month. So I know we've seen a good recovery in the mid caps and small caps. If you're a long-term investor, maybe this is a good time to top up. But if you're playing for the next 1 to 3 months, I would still go with the large caps.